Time is now 7 o'clock.
Reaching you at the highest mountain and the lowest valley. Higher Ground Gospel Radio.
Hi there. Can we talk? Can we talk about mortgages? Yes. Securing a mortgage should be the most fulfilling experience of your life. However, this process sometimes can be a little confusing and indeed frustrating. How is it that we improve on that? Simply join me, Oral McLean, the Mortgage MC, on HGG Radio, Tuesdays, 7 p.m. Mountain Standard Time, as I provide you with simple, professional, and unbiased advice on securing a mortgage. Let's talk about mortgages. Yes, talking mortgages. See you soon. Hey, brothers and sisters. Pleasant good evening to all. My name is Oral McLean, and I'm the Mortgage Mac. Some people call me the Mortgage MC. And welcome to Talking Mortgages. This is episode 2 of what we hope to be many, many episodes until you are all mortgage experts and have gone through the process and done it successfully. We have a show this evening for you that is filled with information, and we hope that it will be edifying as well as entertaining. We have a few giveaways too. We have a couple of gift cards that we have to give away from Timmy's and indeed Starbucks. So let's listen a little more though to Jermaine as he sets the stage for us to start. Right, brothers and sisters. All right, so let's look at credit. And your credit score is usually ranges from 500 to about 900, all right? Thereabouts. 900 being the highest. Usually, 680 is a good enough credit score for you to secure a mortgage and get some of the better interest rates. But how is it that this credit score is done? What does it comprise, right? And your credit score has 5 main elements. These are your payment history, the way you use your credit or credit utilization, and the length of your credit history. So how long you have had each account, public records, and of course the number of inquiries. And the way this is done is that 35% of the weight or 35% of the consideration as to what goes into your credit score is your payment history. So that one is the most important element in calculating your credit score. And what that does, it looks at whether or not you're making your payments on time, whether or not you pay the full amount or you pay the minimum amount, stuff like that. So making regular credit payments to your credit, whether it's your credit card, your line of credit, your mortgage, whatever it is pretty important. Then your credit history, which accounts for 15% of what goes into your credit score, speaks to the length of time that you have had each account. And just like going to get a job, the amount of experience you have is important. Same thing with your credit score. The length of time that you have your accounts open and being serviced properly usually is pretty important. Then public records. And public records speaks to things like bankruptcies, collections, and other public records, like if you don't pay your traffic tickets and they end up on your credit report because they were handed over to collectors and stuff like that. So these are negative items, right? So you really don't want these on your credit because this makes it more difficult for you to get credit. Then inquiries. That accounts for 10% of what goes into your credit score, and the number of inquiries can indeed impact what your credit score looks like. Because every time you go, say you're going to buy a car, and you go and you're shopping around for a car, and the different dealers that you go to, they pull your credit, they look at it. That is what that impacts your credit, because that is considered a hard pull or a hard hit, and that will make your credit score go down just a little. And there's also what we call a soft hit or a soft pull, and that's like when you go on now and you check your credit score, but that one does not have the same impact like the hard pull, because this, you're probably just monitoring to see whether or not everything is okay, right? But the hard pull is the one that you worry about, and more of those that you have is the more it reduces your score. All right, so now that we know what goes into our credit, and we also know that your credit score is basically what lenders look at to decide whether or not you are worthy of getting a loan from them, or if you're worthy of getting monies to borrow from them, and where you are in terms of your score. So if you are below a certain amount, some lenders will not look at you at all, right? So like, say you're going to buy a car, if you're below like 500, 550, you probably have a very difficult time getting a car loan. If you're below 680, you'll have a harder time to get a mortgage. But if you're above 680 and above, usually you get any credit. It's much easier to get credit that way. All right. So how is it that we ensure that we monitor and do things that will positively impact our credit score? 5 quick tips. Tip number 1, and we'll go into each, is to monitor your payment history. Tip number 2 is to use your credit wisely. Tip number 3 is to increase the length of your credit history. Tip number 4 is to limit the number of credit applications or credit checks or hard pulls that are there on your credit report. And tip number 5 is to to ensure that you control the number of credit checks, and also to use as a wide variety of credit sources as possible. All right. So how is it that you monitor? What are the advantages of monitoring your payment history? You're going to monitor your payment history because you want to ensure that you always pay on time. So if you have a credit card, you need to know when is it that your credit card monthly payment becomes due. You want to make sure that your payment is not 30 days late, right? So one of the things that you do, you ensure that you check your statements, and nowadays everybody has their accounts online and it's on your phone, so you can actually check your statements. You can set up notifications that tells you when your statements are available, and then you can check, because one, you want to see what it is your minimum payment that you need to make. Because the mistake that a lot of persons do is that because you're worried about the amount of credit that you have utilized, and you're worried about paying off that huge amount, you overlook what the minimum payment is. Because if you make the minimum payment, what they're saying is that as long as you make this payment, your payment is on time and it's adequate, right? So monitoring to make sure that you pay on time, and that is very important too, because if you have late payments, that goes on the public record, because that now is a negative item, right? And you don't want to accumulate a number of late payments, because the more late payments you have, the lower your score is going to be, and the more risky you're going to appear to creditors. Then one other way that you can monitor your payments is to contact the lender if you're gonna have trouble paying your bill, right? So if you make arrangements and then this is done beforehand, right? Then it might not be reported to the credit bureaus as you making a late payment because you have made arrangement with the lender. And as long as you keep that arrangement, in most cases, you'll be good. One thing that you must try not ever to do is to skip payments, because say there's an item on your credit card and you're disputing it, and because you're disputing it, you don't pay. No, pay, make the payment. If it's even a minimum payment, make that payment and still do your dispute, get it sorted out, because I can assure you, any institution in Canada that there was a dispute and it was resolved, if there's monies that you paid and it was too much, you'll get your money back. However, if you don't make your payment because you're disputing it and your payment is late, it's going to impact you negatively, and then there's no way of fixing that. All right? So make the payment while you do the dispute. All right. So use credit wisely. And I know this is easier said than done, because sometimes, as my grandmother would say, rat have money will buy cheese. You have the credit available. Some people just go on a spending spree. You can, if you are able to repay it, right? But if you know that you might have problems repaying, it is important to use your credit wisely. And how is it that you use your credit wisely? One, if you have a limit of $2,000, you must not spend off your card $2,000.01. Don't go over your limit. Stay within the limit that you're allowed to borrow, because that's what you're allowed to borrow, right? And if you go over that limit and you're not authorized, then it impacts you negatively, and that will cause your score to go down. Another way that you use credit wisely, and this is the optimum, if you keep your credit cards, your lines of credit, all the revolving credit, if you can keep those at 30% or below the max, the limit, your credit score will benefit tremendously, right? If you can keep your credit utilization below 35%. So if you have a credit card that has a limit of $10,000 and you spend $3,499 or $3,500 of that, you are maintaining the optimum. That's the holy grail when it comes to credit utilization, 35% or less, right? And that way you'll get all the bonus points that come from that. So if you have a card and it's $1,000, remember the card that you had before is $10,000, right? And you can spend up to $3,500 and you are still below what is considered the best place to be with that, right? If you have a card for $1,000 and you spend $400, you're at 40%. So you're not really at that 35, which is the sweet spot, right? So what you do in a case like that? You try to get a card. You try to get your credit limit. You try to get that increased, because it's not the amount of money that you spend here, right? It's the percentage. So one easy way to get below 35%, that if you have a card and it's at $4,000 and your limit is $5,000, and that there is 80%, the easiest and best thing for you to do is to try to get your credit card company to increase your balance, so that the percentage, because with the increase in the balance, wherever you are, the percentage will be decreased, so it reflects on you in a positive way. Next tip is to increase the length of your credit history. And that is the older accounts that you have. And I know some people will say, no, I'm getting a new credit card from X company or Y company, so I'm going to switch the one that I have now. That might be wise, right? But keep the other one open, because newer accounts, you are penalized for that, right? So you lose points for that. And older accounts, the older the accounts are, the better they are, right? So you get bonus points for things like that. So keeping your existing and long-standing accounts, that's a very good thing to do. All right. So next tip is to limit the number of credit applications or credit checks or hard pulls that are on your credit report. And it's normal to expect that you're going to apply for credit from time to time. But when lenders look at your credit report and see a lot of credit checks being done, they might think that you are in some sort of financial problem, and so you're desperately rushing out and checking everybody for credit, and that might reflect on you. Well, not might, that will reflect on you badly when it comes to your credit report. Because if in a 2-month period they see 5, 6, 7 different entities pulling your credit, then they're going to think that, no, something is wrong with this guy. They're having financial problems and they're out there looking for credit in order to bridge the gap. So the question you might ask, and at this time I'm inviting anybody that's listening, if you have a question, you can use the usual text line and send us a text or give us a call, and we'll be more than happy to answer any question that you have, whether it's credit or any other aspect of mortgages. You can chime in and we will be able to answer those questions for you. But in the meantime, I'll still go through with credit. But if you have any questions, you can chime in. And I must say that the first person to send in a question will receive a $25 Starbucks or Timmy's gift card. All right. So if you are shopping for a car, and what a lot of car dealers do is that they will take your ID and go and check your credit to make sure that they're not wasting their time, right? I don't know if the practice is legal or not, but that's what I've observed. So one of the things that you can do is to tell every car dealer that you go to that, listen, I don't want you to check my credit until I'm sure that I'm going to buy the car from you, right? That's the first thing you tell them. Because if you don't authorize an organization to check your credit and they do so, that's not legal. They have to be authorized by you to check your credit. And giving them your driver's license is almost like giving them authorization, right? But if you explicitly state that, listen, don't check my credit until I tell you to, until I'm sure that I want to buy this car, or until I'm sure that you are the right dealer for me, all right? So that's one of the things that you do. If you say you're shopping for a mortgage, you might want to go to 5 different places to see who has the best rates and things like that. And when they're checking to see whether or not you qualify, they might check your credit. So if you go to 5 banks, they might check your credit 5 times. So you already know the best thing to do in order to avoid that is that you come to me, Oral McLean, the mortgage MC, and I will check to see whether or not you are qualified or you will qualify and see your chances of getting approved. And here's the thing, I'll only check your credit once. So no matter how many lenders I'm looking at to see whether or not they have the right product for you, I'll check your credit once, so that won't be a problem, right? And of course, our next tip is to control the number of credit checks. That's what we were into. You try to ensure that when you're applying for credit, you do it in a way that is efficient, right? And you make sure, you ensure that when you apply for credit, you do it where you do the legwork first before you allow people to check your credit. All right. Another way is to use different types of credit, right? Because ideally, we want you to have at least 2 credit lines, meaning 2 different forms of credit. So say you have a car loan and a credit card, that's good. Or you have a credit card and a line of credit, that's also good, right? But if you have like just one credit card and you hardly ever use it, that too can be a little dangerous, because if there's nothing to report, there's no way that you're not showing that you are managing your credit, right? So if you have a credit card and you have a zero balance on it, right? At least once a month, go to the gas station, buy some gas, and then you pay the balance off in 2 to 3 weeks. That's good, because at least there's something to report that, yeah, you had a transaction and the balance was paid, so a payment was made. So that is how you ensure that your credit score is maintained, stays high, and your credit worthiness is superior to the average person. So let's listen again to Jermaine while we consider all of that and give persons an opportunity to send in their questions or call in their payment. And our listener wants to know how much down payment is needed when purchasing a house. All right. Well, in Canada, the minimum down payment that you can put down when purchasing a house is 5%. And you can put 5% up to whatever amount that you want for a down payment, but 5% is the minimum amount. With 5%, what happens though is that your mortgage has to be what we call insured. And why insured? Because usually before we were at 5%, the minimum that you could put down was 20%. However, at 20%, and even to this day, at 20%, if you put 20% down, your mortgage does not have to be insured against default. And you'd say, whoa, that's nice. However, when you put 5% down, most of the times, you get a much better rate than when you put 20% down. And you're wondering, why is that so? The simple answer is, when you put 5% down and your mortgage is insured against default, and let's knock on wood, you have a mortgage of $100,000, right? And you had put 5% down, you default on that mortgage. And when you default on the mortgage, say the bank takes the house back, they resell it. When they resell it, they don't get back their 100,000, they only get 70. What happens then, if your mortgage was not insured, what would happen is that now the bank is coming after you for that extra $30,000. And what they'll do this, and whatever personal property you have a car, they might take it, sell your furniture, whatever else they can get their hands on, right? But if your mortgage was insured, the insurer is now responsible for paying the lender that extra $30,000. And that is why when a mortgage is insured, you get better rates, because now it's a smaller risk than the one that is not insured. So 5% down is the smallest amount that you can put down, but it does give you way more advantage in terms of getting better rates and other perks when it comes to a mortgage. However, when you put 5% down, what happens though, that insurance against default, you pay the premium, and those premiums are collected up front. So what they do, they work out what's the percentage more that you're going to pay, and then they add that to the overall mortgage amount, right? So the premiums is added to the mortgage amount. You pay it over the life of the mortgage. In most cases, it's 25 years, right? So you really don't feel those premiums, but it offers you that extra layer of protection where the lender sees your mortgage now as a smaller risk than if you had put 20% down. So that's the advantage there. The disadvantage to that is that when you put 5% down, usually your monthly or your bi-weekly payback amount is a little higher. However, when you put 20% down, the advantage is that you don't pay the default insurance premium, right? But because you are paying slightly higher interest rates, because it's not insured, your lender looks at it as being a slightly higher risk than if it was insured. So in that case, you're while you're not paying the default insurance premiums, but you're gonna be paying higher interest rates, and that might work out that your repayment amount is a little higher, even though in truth and in fact, your repayment amount might be lower than the person that had put 5% down, because you have a greater down payment, your mortgage amount is smaller, right? But if you were to do it dollar for dollar based on how much you got, because your interest rates are going to be a little higher, then you might be paying a little more. So the ideal amount, the lowest amount for down payment, 5%, and you can go any amount over that. But any amount 20% and greater, those mortgages are not insured. And then they are viewed as a higher risk. All right, we have another question. Can a new homeowner get a mortgage without a down payment? All right, that is what I call a trick question because the answer to that is yes and no, right? Yes, you can get a mortgage without really making a down payment, because in a case where the down payment is zero, what you're really doing is that it's $0 from your personal funds. Because what you're doing then is that you're borrowing the down payment. And this is what we call a flex down mortgage, where the down payment is borrowed, right, from like your line of credit or something like that. And thing is though, in order to do that, one, your credit has to be 750 and above. Two, you have to have very, very low debt burden, meaning that your monthly repayment for debt is very, very low, probably in most cases zero, because that now is going to be calculated to see whether or not you qualify. And that calculation as to whether or not you qualify is going to determine whether or not you're going to get the mortgage at all. So yes, you can go without a down payment in theory, because technically you're going to have a down payment because you're really borrowing it. But having a down payment that comes from your pocket or your personal funds, like your savings or your RRSPs or things like that, right? But yeah, you can do it. And no, and when it's no, it's because you probably don't have the requisite credit, the requisite credit score, or you have other obligations in terms of debt repayment that will not allow you to qualify based on the calculations. So it is possible. So if your credit is great and you have very, very low debt repayment, monthly debt repayments, then it is possible. And if you need more information on that, you can set up a time and we can go through that, any of our listeners. Another thing with down payment, as we are on down payment, is that down payment can come from a variety of sources, right? It can come from your savings, like your savings account, your RRSPs, and especially if you're a first-time home buyer, there's an incentive for you to use your RRSPs, because then you won't be penalized for taking the money from it, right? It can also come from a gift. So you can get a gift from immediate family member, and who are classified as immediate family members are mother, father, brothers, and sisters, right? You can get a gift from them, but there's a document that must be signed that states that this is a gift, will not be repaid, and it's coming from whoever it is, and that person signs, and the person also getting the monies will need to sign too. Yeah. And you can also take down payment like from investments. So you might have some money that you have gained in stocks and shares and bonds and things like that. You can take money from that. Or you can take equity from an existing property, right? And you can use the monies that you get through like a refinance of that property to pay as your down payment. Yep. So, very interesting question. Thanks for the questions. Really appreciate it. And our winner for our gift card is Princess. Yeah. Princess is the brave listener who always texts in when we have giveaways. I appreciate you, Princess. Thanks for participating. And thanks for asking those very, very potent and probing questions. All right. So I'm just gonna wrap up this week's show, and I want to say thanks to everybody that tuned in and listened, and the questions that we got. Thanks to my producer, the great Roshane Douglas, and thanks to you. This is Oral McLean, the Mortgage MC, and that's my 2 cents for this week. Next week, we'll look at another informative and important topic as to how is it that we go about getting a mortgage and getting it successfully in Canada. Thank you for tuning in, and we'll